The market continues to receive mixed inflation data, and the central bank policymakers are only making forecasting more difficult. Deflation in the United States appears to have stalled. The long-awaited January PCE showed that headline and the core inflation continued to decline, but the 6 months annualized rate rebounded to 2.5%. However, Fed officials aim to overcome any red blocks to deflation. The policymakers have reiterated their confidence that they can ease policy in 2024. Against this backdrop, the US dollar index inched down 204 points on a Friday, losing Thursday's gains and coming under pressure from the Fed's dovish comments. Markets are now pricing in about a 2/3 chance of a rate cut in June, with no change expected in March and May. The new week promises to be quite hot for global markets. The focus will be on economic activity, the US labor market, Powell's speech, and the key interest rate decisions from a number of central banks. In our video review, we will tell you which macroeconomic releases to watch and when to pay attention to them. You are watching the Trader's Calendar. So, on Monday, the macroeconomic calendar will have no important data to offer. On Tuesday, during the Asian session, more or less important reports will be released. First of all, it's a Japan Services Sector Activity Index. The yen has come under tremendous pressure this year as the Bank of Japan has maintained an ultra-loose monetary policy, while other major central banks have continued with the restrictive policies. The Japanese yen held above 150 per dollar, as Bank of Japan Governor Kazuo Ueda said that it was too early to foresee sustained achievement of the central bank's 2% target, emphasizing the need to scrutinize additional data on the wage outlook. He added that the regulator needed to confirm whether the wage inflation cycle was starting to turn positive. With this in mind, the Business Activity Index may provide a slight boost to the pair's movement. According to preliminary estimates, the PMI for February is expected to decline to 52.5 from January's 4-month high of 53.1 amid slower growth in the manufacturing sector. Rising new orders and signs of a tightening capacity led to the strongest rise in employment in 9 months, while backlogs grew faster. If the preliminary estimates are in line with the expectations, the yen may strengthen against the US dollar. Otherwise, the pair may continue to trade above the 150 level. Volatility is also expected to increase with the release of a China Services Sector Index. The offshore yuan slumped to 7.21 per US dollar, trimming gains from recent sessions after data showed that the manufacturing sector contracted for 5th straight month in February. China's Taishin Services PMI for January 2024 slid to 52.7 from a 5-month high of 52.9 in December, amid slower growth in new orders. It was the 13th consecutive month of growth in the services sector, signaling further solid expansion in the sector's output, supported by firmer underlying demand and a new client acquisition. With a new report, investors are expecting growth to continue. The figure is expected to rise to 53.4%, according to analysts. If the data disappoints, the yuan may come under additional pressure, as investors are now looking ahead to next week's National People's Congress, where politicians will set economic targets and the policy priorities for the yen. On Tuesday, investors will evaluate the fresh US ISM non-manufacturing PMI for the US non-manufacturing sector. The index jumped to 53.4 in January from a 50.5 in December, beating the forecast of a 52. It was the strongest growth in the services sector in a few months, led by the new orders. At the time, services firms were optimistic about the economy because of the potential impact of lower interest rates, but cautious because of inflation. Since then, inflation has changed, and if you ignore the dovish tone of Fed policymakers and focus on the data, you can expect a decline in optimism. Based on the report, analysts are expecting a slight drop in the index to 53.3%. However, the US dollar may strengthen slightly if sentiment falls deeper. This could be another argument for keeping interest rates at restrictive levels for longer, as the forecast was exceeded. On Tuesday, it's worth paying attention to the political events. Super Tuesday is the day of the US presidential primaries, when the majority of states vote. Biden and Trump will be in the spotlight, and the US dollar will not miss the opportunity to react to political statements. On Wednesday, the Bank of Canada will kick off a week-long series of central bank meetings. Recent data showed that the Canadian economy grew at an annualized rate of 1% in the fourth quarter, beating expectations. And this result should ease pressure on the central bank to cut interest rates. GDP came in above the Bank of Canada's expectations of a zero growth and analysts' average forecast of a 0.8% growth. According to Statistics Canada's preliminary estimate, January GDP likely increased by 0.4% from December. The results, while mixed, would signal that there is no urgency to cut rates. The Bank of Canada has held its key overnight rate at a 22-year high of 5% for the past 4 meetings in an effort to eradicate core inflation driven by housing costs, food prices and wages. The Bank of Canada is expected to keep rates unchanged at its next policy statement on a Wednesday. The Forex market is pricing in more than an 80% probability of a rate cut in June, with a 25 basis point cut fully priced in for July. Against this backdrop, the focus will be on the Bank of Canada statement and outlook. If the regulator maintains its hawkish tone, the loonie may strengthen, while a shift to soften rhetoric could further weaken the Canadian dollar. Wednesday will promise a rather challenging time for the US dollar index. The day will be important and volatile. First, investors will assess 2 reports on the US labor market, and the trading day will continue with the Fed Chairman Jerome Powell's speech. The first will be ADP non-farm employment change report. In January, the number of hired workers decreased to 207,000 from 145,000. The strongest growth was in the leisure and hospitality sectors, but wage growth continued to slow down. The market is expecting another drop in hiring to 90,000 in the latest report. If the number is higher, the US dollar may receive support in the short term. Next up will be the JOLTS job openings report. Last month, the number of job openings rose by 101,000 to 9.26 million, the highest level in 3 months. The fresh data is expected to show a cooling of the market and suggest that the job openings will fall to 8.9 million. If the data points to a cooling market, it could weaken the US dollar. Given the importance of these reports, the market will get the key employment figures by the end of the week, and Wednesday will only give traders one piece of the puzzle. Therefore, the direction of the US dollar index will mainly depend on the rhetoric chosen by Jerome Powell. Investors will scrutinize his speech after the data release. Given the variety of signals and interpretation of the data from his colleagues, the market will expect more clarity from the Fed chief. A dovish tone may drag the US dollar index down. Meanwhile, a hawkish stance will help help the US currency to strengthen. And this was a brief overview of the most important economic events from InstaForex analysts. Follow us and make hefty profits from your trades. So see you online soon.